on this computer. All right, well, cool. Welcome, guys, to the Road to Retire with JenniFIRE. I am very excited to give a short talk on all things money as I've come to know them, and I'm excited to share about today. I know we got started a little bit late, so we will probably let questions go over for like the last 5 or 10 minutes. And if you have to leave, that's okay. Please feel free to email me questions. But yeah, I'm sure you guys kind of know a little bit about me, but again, my name's Jennifer Butterfield. I do personal finance consulting. I'm based out of Austin, Texas, and I'm currently in the process of completing a Master of Science degree in Business Analytics. I am a student and alum at St. Edward's University. And I also host a podcast about personal finance, which I absolutely love. I have new guests on each week, and it is the Trial by JenniFIRE podcast series. So if you haven't caught it, feel free to check it out on any podcast platform. And I'm passionate about educating others on financial literacy and growing wealth. And I'll go ahead and start with some budgeting. I think that this is a topic that comes up a lot. And I think this is probably the thing that I see the most people struggle with because it requires discipline and maintenance on a day-to-day basis. And so much of the messages that I think advertising and marketing target for consumers is to spend and instant gratification. And so a lot of people fall into this trap of impulsivity when it comes to I need this and discerning the difference between a need and a want. And so I want to talk a little bit about the different types of income and how budgeting for different types of income can look a little bit differently. The way I break it down is usually through traditional employment, which is like W-2, W-4, either salaried or 40 hours a week. And then there's also self-employment. And so the major difference between these two things is one has more stability and the other is has a little bit more of a tendency to fluctuate when it comes to income. Another major difference is going to be setting aside money for taxes in self-employment. And so I'll just kind of go into some of the basics that are going to be true for both. I tend to recommend going through a line item analysis of each expense on any major account. So if you have a debit or checking account, as well as credit card accounts that you use on a frequent basis, any of these going through for traditionally employed people, I tend to recommend about 3 months, typically because there are more fixed expenses and more consistency. So you'll see less variance. Whereas with self-employed people, I say maybe 6 months to even a year to get an idea of the ebb and flow of what a business is bringing in throughout the year. And so oftentimes there are, annual dues or, setting aside money for taxes. But yeah, just to go into kind of the basics of budgeting, I highly recommend categorizing expenses and thinking of it in terms of buckets. So, I think of it in terms of housing, transportation, utilities, food, and then, like wants, and then saving and investing. One thing that I highly recommend people taking advantage of if they are in a traditionally employed environment is 401ks or any type of tax advantaged accounts. So one that I think is really commonly overlooked is a health savings account, which is kind of like a little bank where you can put aside money before income tax is taken out of a paycheck. And you can use that not only for qualified withdrawals, but later on down the road, if there is still a little like nest egg, you can use that for retirement. And so a lot of people aren't aware of that. And so I always like to mention it. One thing with traditionally employed folks is that there is oftentimes a salary increase or pay increase, annually or biannually. And one thing to be really mindful of in both scenarios is lifestyle creep. And I think this kind of goes back into tying in this idea of delaying gratification. And I think it really stems from this consumer-driven economy that we live in. And so being mindful of what does it look like to continue to live beneath my means? Do I really need to upgrade the car or the house or buy a whole new wardrobe or whatever it is? And I think it's important to say, yes, meet your basic needs, but I know so many people who make well over six figures at this point, and they continue to get a nicer place or a nicer car every time they get a promotion at work. And that can oftentimes really have a long-term impact when it comes to retirement and long-term savings. I recommend if you don't necessarily have the muscle memory of budgeting on a frequent basis, to review your expenses and your budget, if not every day, sometimes weekly, but definitely monthly. Always automate bill payments and savings if you have the ability to do so, and pay your fixed expenses first. With self-employment, it's recommended each time you get paid to pay yourself first, and set aside about 20 to 30% of all of your income for federal and state taxes. And I tend to recommend building out an emergency fund. So this is about 3 to 6 months if you're traditionally employed, or 6 to 12 months if you are self-employed, of income. And I think a lot of people might say either expenses or income. The important thing is to have a little nest egg that will cover you for anywhere from 3 to 6 months if you're traditionally employed, or 6 to 12 months if you're self-employed. And keeping in mind, if you are self-employed, thinking about those annual expenses. So if you have dues to pay or insurance to pay, premiums, and then cross-line depreciating those big expenses, if it's biannually or each year, taking the cost of that premium and dividing it by 12 and factoring that into your budget. And again, that comes from taking a line item analysis of your previous expenses from the year prior. With that, I think it's really important to talk about this idea of compound interest. And hopefully you guys have heard a little bit about it and maybe you understand it already. I was shocked when I first got introduced to compound interest. People have told me that it's the eighth wonder of the world, and indeed, I agree that it is. It can be calculated with a mathematical formula, which I think can kind of feel overwhelming a lot of times, but I like to break it down in this example. So I've got two different people, and person one is going to invest $1,000 a year right out of high school from ages 19 to 28. They're investing only 10 years and they never invest again. Person two invests $1,000 a year from ages 29 through 65, and that's 37 years. So they get started right when person one ends, and they keep contributing $1,000 to an investment account for the next, over the course of their working lifetime, so up until retirement age. Assuming there is a 10% rate of return on average for each year, which is around what the S&P 500 index funds average. We'll see that person one invests a total of $10,000 and person two invests a total of $37,000. And so here's kind of what that looks like. As you can see, person one is going to retire with an initial investment of $10,000 for 10 years. And they're going to end up retiring with $596,000 $128.90. And then person two starts 10 years later, keeps investing the same amount for 37 years. And they invest $37,000, and they're only retiring with a little more than half of that. And I see something in the chat. Let's see. Yeah, I know, me too. But it's never too late to start investing and start knowing about this today, because I think time is always on your side, in the sense that, like, I think the biggest mistake is just not starting now. You know, we all find this out at different points in life, and yeah, it's never too late to start. So with that, I'm going to go ahead and go to the next slide. So here are a few different types of investment vehicles. I'll go through them quickly, and we can talk a little bit about them, but I really want to get into what a Roth IRA is, how to open one, how to start one, things like that. So we have stocks, and the common risks are going to be like the risk and volatility, diversification, and it's important to do your own market research. You can invest in stocks and mutual funds and exchange traded funds through a brokerage account. And you can also work with a financial advisor who will diversify your portfolio for you. Bonds are an interesting vehicle. A lot of times portfolios will see stocks. Oh, we lost Alana, and here she's back. Cool. A lot of times people will see, you know, advisors investing primarily in stocks throughout the majority of someone's working lifetime. So around like 45, 55 years old, as they're approaching closer to retirement, they will kind of shift gears and start investing in bonds, because those will actually pay out over the course of 10 years. And so those are a great vehicle for those who are nearing retirement. Real estate is a great investment vehicle. Obviously, they are subject, these investments are subject to market conditions. And a lot of times the illiquidity of real estate can be something to consider, as well as like closing costs and operating costs, because managing a property does require an additional investment, as well as insurance. Retirement accounts. So this was kind of what I was talking about when we were back on the budgeting page, where we're talking about tax benefits. So tax advantage accounts like 401ks, HSAs. You know, if your employer will match a contribution for any of these accounts. And then there's some things to consider with these, like with retirement accounts, there typically is a withdrawal age, or like a maturity of the account. So, you know, that money has to sit in that account for up until you reach a certain age. Typically it's like 59 and a half or 65. And if you withdraw that money prior to those ages, then you will be taxed a penalty, and it can be like 40% of the withdrawal. And so you know, I think this is a really important thing to be aware of. If you are using anything like a Roth IRA, a traditional IRA, a rollover IRA, or backdoor Roth, any of those are great vehicles. It's important to understand the terms before investing the money into those accounts. Private equity and hedge funds, these are like the go big or go home type of funds. I worked at a private equity firm for a little while, and I think they were doing a series of funds, and I think they had about 280 investors, and the minimum contribution was $500,000, but they had some people who would invest up to, you know, 2 million per person, or per party rather. And it's a high risk and a high reward. And so oftentimes the people who are managing these funds are very knowledgeable and trustworthy people, and it's important to have in-depth conversations and be really clear about what those funds will be purposed for and what the terms are in terms of callbacks, because throughout the course and the maturity of the fund, a lot of times they can call for a callback, and that means to put down another portion of the fund or your investment in it. And that can come at any time without warning. Commodities, when I think of this, I think of things like gold and silver and platinum. There is a lot of market volatility, especially now that the dollar is not backed by gold. And there is an opportunity for diversification, but thinking of things in terms of physical storage and insurance on these types of investments is incredibly important. And then CDs, again, this is another one where, the risk is going to be thinking in terms of the liquidity and the terms of the deposit. A lot of times when you invest funds into a CD, there is a hold on it. And so withdrawing it prematurely can have a negative impact on the investment. They are insured by the FDIC, and interest rates are an important part to consider for this as well. So I want to talk a little bit about, let's see here. Oh, okay. Opening a Roth. So a lot of people who will qualify for a Roth IRA, you need to have a certain, be under a certain earned income. That doesn't necessarily mean your net worth. It just means that the earned income that you make within a year has to be under a certain number. And there are different solutions if you do have higher earning potential than what the limit is. Doing something like a backdoor Roth is an option as well. And those are a little bit more complex, but some things that you might need in opening a Roth IRA or a traditional IRA or even a custodial Roth, which would be an investment account for a minor, somebody who's under the age of 18. You'll need a social security number, proof of residency. You would need to think about who your beneficiary designations would be for. So, if something were to happen to you, who would you leave this account to? And then you'll need a pretty nominal, at minimum, initial contribution. A lot of times people think the barrier to entry with these types of investment accounts are going to be much higher, but I love to remind people that these major institutions have made investing very accessible. I think it's really interesting that just in the past 50 years, women have had the ability to own their own bank account. And that just came up to the bicentennial mark this year. And so, the barrier to entry, you can start one of these accounts as low as $50. There is 3 major institutions, and again, these are also institutions that you can open a brokerage account with, which is just an investment account that has a little bit, it depends on the terms, but it has a little bit more liquidity ability, so you can sell the stock and then withdraw the funds. And a lot of times there isn't a penalty, or if it is a penalty, it's fees or capital gains tax. Which would just be the tax on the dividends that were paid out from the stock. I personally have my Roth IRA with Vanguard, but I have quite a few clients who are with Fidelity, and my aunt works with Charles Schwab. I am a huge fan of opening a Roth. The contribution limit this year is $7,000. One thing that I was horrified to learn on my own about a year after I learned about Roth IRAs is that you can't just put the money in there, that you actually have to invest those funds. And so, obviously something as risky as investing should definitely be well researched and consulted with a professional if that is the route that you want to go. And a lot of times those professionals will charge fees to manage portfolios and stocks. And so that's something to consider. If you're not comfortable with it, that's definitely a helpful tool. But again, a lot of these institutions and the way the information is so accessible today, they have created much higher levels of accessibility. And so people are able to get into the market and learn and research about different ways to invest, different stocks and things like that. And it can definitely be done on an individual basis as well. I highly recommend when thinking of long-term investments such as retirement funds to look into an S&P 500 index fund. And so for each of these different institutions, I went ahead and put the ticker symbol. I did create some content recently on how easy it is to invest the contributions to a Roth IRA or any stock for that matter. Just going and finding the ticker symbol, setting the amount that you want to buy. You can either buy it through the number of shares, or you can buy it through the dollar amount that you have available. And obviously, year by year, the market is going to look different in terms of return. So, I mean, some years you're going to see as high as like a 12% return. Other years you may see something as low as like an 8%. It typically falls within that range. And over the course of a working lifetime, historically speaking, the S&P 500 averages at around 9 to 11%. Annually. So I think that is a solid and secure investment. And obviously there are different vehicles. So like real estate is a great vehicle. Like I mentioned, bonds closer towards retirement age can have a good impact on just generating income year after year when you're in retirement. But I think that the Roth IRA, and then I don't personally have children yet, but a lot of my clients are just starting families, and those who are self-employed can pay their child a paycheck out of their company name, such as like for baby modeling, or maybe they have them put stamps on envelopes or whatever task it is for their business, maybe organizing a drawer, just something that has their name printed on it. And because it's their child, it's legal, like it doesn't fall under the child labor laws. And so they can actually take that pay stub and go and open a custodial Roth IRA for their child and receive the benefit of compounding interest and the time value of money. And so they can get started much earlier in life and retire a millionaire or multimillionaire just by small contributions while they're still under the age of 18. So these three institutions, I think, are probably the primary ones. I'm sure that there are others out there that offer Roth IRAs, but I think these are some of the most trusted. That being said, they take maybe 15 to 20 minutes to set up one of these accounts, and you can take these things that you'll need and then do it online. So each of these should have an option to set up the account online. And once you have the initial contribution made, don't forget to invest it. Again, I invest my contributions in the S&P 500. There's no time like time in the market. And so I think a lot of times people have this inclination to take the money out early or to sell the stock or whatever. A lot of times people panic if the cost or the value of stocks declines, especially when it's below what you purchased it as. But a lot of times, I mean, the S&P 500 has had a upward trajectory throughout the course of its history in the past, I think 75 years. And so it's a pretty reliable, low risk fund. And Obviously, individual stocks are great, but what I love about the S&P 500, it is a little piece of each of the Fortune 500 companies. And so those are wonderful. And it's like a little bite of all of them. And so that I think is why it historically has done so well. And again, it's pretty low risk.